and revenue growth guidance ahead of expectations. We're joined by Ravi Kumar, the CEO. Ravi, before we get chatting about the results, do you want to comment on the tech wreck that you're seeing globally now? Is this overblown or is this a cause of concern?
Look, it's a little irrational and illogical to think that this brilliant, extraordinary technology we have in our hands will magically, get plugged into businesses and there's going to be value there. It's not going to happen. It's not happened before, and it's not going to happen in the future. In the last 1 or 2 years, we had $600 billion of AI infrastructure being built by the hyperscalers and the frontier model companies. That value has to drift to businesses, and the drift is going to happen in a slow and steady fashion. And this is a contextual, it's a contextual technology. It sits around the LLM versus software written in the past, which was value around the microprocessor. So you need contextual engineering to ground this technology in the business, in the heterogeneity of business, to understand the hustle of the company, to understand the work patterns, the flows, and everything else. It has to integrate into the operating and physical layers of enterprise landscapes.
But, there are two concerns. One is the increase in revenue deflation from the current 2 to 3%, maybe to, say, 5 to 6%. And second, that there will be no added uncertainty into client decision-making process until the AI architecture settles down. Do you think this is likely?
It's a very simple philosophy. I have two swim lanes on my strategy. The first swim lane is, how do I apply AI and create more productivity on the software we wrote for the last 25 years, which is more deterministic systems of record, layers of value which are logic-driven and algorithmic-driven. So are we going to do it in newer ways? Yes. The throughput we are now getting from our developers at the bottom of the pyramid is very high. In fact, we went from code assist platforms which support synchronous productivity improvement for developers to asynchronous productivity development. What I mean by that is, a software developer is using the tooling to increase throughput, but building agents around them and actually asynchronously delegating them. I call it macro delegate. And then steering them, I call it micro steering, to actually get nonlinear productivity. And when nonlinear productivity comes on traditional software or classical software, you're actually going to consume more, you're going to take the backlog off, and you're going to take the technical debt off. So that is the first swim lane. Is that going to be deflationary? It's going to be deflationary, but it's actually going to create, because it has elasticity, it's going to create more throughput or more consumption.
Ravi, your constant currency revenue growth of 4 to 6.5% in 2026, which includes inorganic contributions of 150 bips. How's the demand environment looking like right now?
At the start of last year, the midpoint of our guidance to the start of this year, the midpoint of our guidance, we went up by 150 basis points. So it is better than organically. So it is better than last year's guidance we originally gave. We beat that guidance. We upped the guidance in end of Q3, and we beat the guidance which we had last year. We improved our margins. We had an expansive margin, and we had 11% EPS growth. So last year we did 6.4% revenue growth, 11% EPS growth, and our margin went up from 15.3 to 15.8. So we kind of ticked all the boxes. This year, we are again starting higher than last year, and we are hoping that we continue on that same trajectory. If you take the comparative group of 10 providers, tier 1 providers, we went in 2022 from being at the 10th spot to the 8th spot to the 6th spot, and now we are in the winner's circle, as we call it, which is the top tier performance. So we want to continue on that journey, and we think as we progress in this year, with the tailwind of 28 large deals, we have done $100 million, 28 large deals. We've done one in Q4. We did a big $1 billion deal. We did 2 $500 million deals. So we think we have the tail velocity as they get to transition and get to production. We're going to see more traction in quarter 2 and quarter 3, and it'll help us this year. Now, coming to the macro still remains uncertain. It is, it's dynamic, and we believe discretionary is in pockets good. For example, in financial services, discretionary is pretty good. We did very well in financial services. We did 9% in quarter 4, and for the full year we did 7%. It's our largest vertical, so we feel very excited about it. The second largest vertical is healthcare. We did 6.5% there, so that also is in a good. And both of these are organic, because both healthcare and financial services didn't have any contribution from inorganic. So the top 2 verticals for us overall are in a good trajectory. The rest of the discretionary has not picked up, but the AI spend can trigger a capex cycle, and if it triggers a capex cycle, that will actually trigger a discretionary spend cycle as well. Our opportunity is not just on discretionary. Our opportunity is also around consolidation. Remember, the first swim lane is more consolidation, wallet share swap, and the second swim lane is net new spend. A lot of work is happening in the first, and the second is just taking off. So we're dependent on both. One is consolidation, and the second is new spend cycles.
All right. Thanks a lot for that, sir. And we'll take this, forward itself. In fact, layoff plans in the US, they've hit their highest January total since